integrated reporting. So financial reporting are the financial results of an organization that are released to its stakeholders and the public. They help any stakeholders or the general public to analyze, to differentiate, to make economic decisions, and various other things as well. Financial reporting basically is a standard accounting practice that uses financial statements to disclose a company's financial information and performance. It is important for management to make informed business decisions based on facts of the company's financial health. It is also used by potential investors and banks and will also help them decide if they want to invest or loan the money. Even regulators or the authorities.
Sidharth sir,
Yeah.
Sorry for the interruption. Can you please put on your camera, sir?
Sure.
Okay, thank
Yeah.
you, sir.
Yeah. So this reporting is a key function of the controller who may be assisted by the investors relation officer if an organization is publicly held. As of now, as per the norms in India, all listed companies whose shares are being traded have to issue their financial reports to the public forum as well. And they are available for public scrutiny and to the various stakeholders as well. The significance of financial reporting is essentially highlighted by the existence of IFRS. IFRS stand for the International Financial Reporting Standards, which productively replace the multifarious national accounting standards in the wake of globalization. IFRS are a list of principles that address the way particular transactions, procedures, and various events should be indicated in a company's financial statements. These principle-based standards are put out by the London-based International Accounting Standard Board, or the IASB. These standards are used by many countries across the globe. They are a set of international accounting standards which state how a particular transaction should be reported in the financial statements. They were established in order to have a common accounting language so businesses and accounts can be understood from company to company and country to country. Earlier, various companies were following relevant gaps which were only being followed by the respective countries. And it was not easy and it was not relevant to compare those financial statements together. More than 144 countries around the world have adopted IFRS, which aims to establish a common global language for company accounting affairs. Even in India, we are now converging with IFRS through our new Ind AS standards. The Ind AS have been prepared by the NACAS and it's recommended and submitted to the MCA. The objectives of IFRS are to establish a universal language for companies to prepare accounting statements. They also establish accounting rules to make it easier for stakeholders to interpret financial statements. They make the accounting statements credible and more transparent. And they also make international comparisons and analysis an easier task. India has not adopted IFRS as is, But however, it has decided to adopt reporting standards which are based on IFRS. In India, those standards are called as Indian Accounting Standards converged with IFRS, or in short, the Ind AS. The Ind AS are framed with minor deviations in IFRS called as carve-outs. Ind AS are applicable to a certain set of companies from the year 2016-17. In its first stage, they were applicable to only the listed companies and its subsidiaries. In the second stage, they were also applicable to companies having a net worth of above 500 crores. And lately, all other unlisted companies which are having a net worth of above 250 crores have been included in this Ind AS. In the sense, they have to mandatorily adopt these new accounting standards. Also, we have the option for other companies to adopt them on voluntary basis. Companies can now voluntarily converge with Ind AS. Ind AS are a very and highly relevant accounting standards. They reduce the gaps or the differences in global gaps which were earlier being followed. However, banks and insurance companies are not allowed as of now to adopt Ind AS voluntarily. There are still researches and studies going on how to include banks and insurance companies in this bracket. Listed NBFCs or non-banking financial companies are which are in the process of listing or have listed have been able to adopt these new financial standards. Audited standalone financial statements as on 31st March are considered for calculating the net worth for the threshold for adopting these new standards. Net worth here does not include revaluation reserves or write back of depreciations or any amalgamation reserves. Once a company voluntarily adopts Ind AS, it shall be followed for all subsequent years. Even if its net worth decreases below the threshold level, still it will be needed to follow these new accounting standards. Lately, now organizations have realized that the current form of annual financial reporting takes a very short-term approach and is probably inadequate to meet the needs of the investors and other stakeholders. Therefore, the need for integrated reporting has been gaining momentum. Integrated reporting does not only include the financial parameters or financial aspects of a company, but also makes the company report on other important non-financial parameters. The practice of integrated reporting has been widely accepted since the release of an international framework by the International Integrated Reporting Council, which is also known as the IIRC. It is a global coalition of regulators, investors, accounting professionals, companies, and non-governmental organizations. The international framework was released in 2013 and stands as a more holistic form of reporting the value of that businesses create. Now, businesses are a part of a society and they are not apart from society. This has never been more true than these last 2 years, where businesses' resilience across the world have been strongly tested in the wake of the COVID-19 pandemic. Almost overnight, organizations have needed to reprioritize the health and safety of their employees, customers and clients, and local communications over their financial profits. They've had to rework their business model and strategies to reflect that. The international framework helps organizations to gain a holistic view of their businesses by providing a clear overview of all their capitals, which is geared towards long-term value creation. Transparency of the key economic indicators and the key personnel and culture can lead to enhanced trust in businesses, especially where there is a balance by honesty about performance and impact. The ongoing pandemic has reinforced our belief that inclusive growth is more important to shape the future. In integrated reporting, a lot of things other than the financial statements are included, which includes things like management commentary, the governance reports, the environmental and social impacts, and the corporate communication. Now, as we all know, that intangible assets such as brands now make up a substantial share or substantial market value of a company. Now, businesses need to show their stakeholders that they create value and report on not just financial capital, but also their intellectual capital, the environmental capital, the manufactured capital, and the human capital. This is where integrated reporting can support us. I believe this decade, we will see a massive progress on integrated reporting, as it is an opportunity to not only differentiate ourselves, but to contribute to shaping a more vibrant economies. Integrated reporting brings together all the material information about an organization's strategy, governance, performance, and prospects in a way that reflects the commercial, social, and environmental context within which it operates. It leads to a clear and concise articulation of the value creation story, which is useful and relevant to all stakeholders. It is an accelerated corporate reporting approach. The idea underlying, which is to report not only on the company's strategy, management, and financial performance, but also on its social, environmental, and economic impacts. IR can also be defined as a holistic report aiming to present annual reports and sustainability reports in a single report. In the IR framework prepared by the International Integrated Reporting Council, companies aim to make company value measurable and therefore more understandable and comparable by quantifying the environmental and social implication as well as the financial statements. Now we come on to the objectives of integrated reporting. There are 4 information categories that a company out there, all underpinned by relevant performance measures. First is the external drivers, which include the competitive environment and the regulatory environment. Next is the strategy or the governance and risk and remuneration for the same. Thirdly is the resource and relationship, which is defined by the financial asset and physical assets, along with the intellectual assets and supply chain. Next is the performance, which includes the economic and operating performances, as well as the corporate responsibility, which all other companies have. Now, the stakeholders do not only look at the financial performance, but they want to know that how does a management think and how does it do business? What are its plans? What are its strategies? And what are its goals? Integrated reporting helps to include all these parameters which are relevant for all the stakeholders and the society as a whole. It helps the companies to have a good relationship with all the stakeholders and also help them know how they create value for the society as a whole. All the company's plans, its future goals, its strategies are included in this kind of reporting. Most importantly, it also includes the ways or the steps it would achieve those goals and the problems it has faced or will face to achieve them, and the overall strategy to overcome these problems. Integrated reporting is an evolving concept. It needs constant alignment to the ever so dynamic society and its ever changing needs. The principles on which the integrated reporting is based on strategic focus and future orientation. So apart from the past results or the historical results of the company, it also focuses on what is the future, how bright is it, what are the goals of the management, and what steps it will take to achieve them. So it is highly strategic focus and future oriented. Next is the materiality. If we have gone through the annual reports or the previous annual reports of companies, we can see there's a lot of information for which the stakeholders probably is not material to them. So integrated reporting principles focuses on the definition or the concept of materiality. It tells the management to disclose only the material or relevant information in the reporting process. The third principle here is the stakeholders' relationships. Once you disclose all these things, these integrated reporting helps in developing close stakeholders' relationship. Stakeholders include the investors, the general public, the society in which it operates, the employees, and all other relevant people or organizations. So in integrated reporting, the management has to report that how it is contributing to that relationship, how it is contributing to the society as a whole. The next principle here is the connectivity of information. All such information, either financial or non-financial, which are relevant to the company, needs connectivity. The second last of this is conciseness. This can be probably also linked to materiality as well, but integrated reporting principle says that the information should be concise. It does not say it has to be a summary, but yes, it should be only the relevant part presented in a concise manner, which is understandable and relatable by all stakeholders. And lastly, it is the reliability and completeness. The entire information disclosed under this reporting should be reliable and complete. As of now in India, we do not have a proper framework for this kind of reporting, and it is only a recommendatory reporting, which was also recommended by our SEBI for some listed companies. But thankfully, a lot of companies are following it, including a lot of good listed companies. We'll get on with that information in our later slides. Our next slide is on why integrated reporting. The benefits of integrated reporting. So as we have spoken, users and preparers have become frustrated with the volume and lack of transparency of current corporate reporting. So integrated reporting helps in reducing that kind of volume, and it increases transparency in the figures and the other reports. Similarly, capital markets need the right information to be delivered in the right format at the right time with the content that the markets believe in. For an example, if a company is probably not making profits, and if we see its financial statements, probably we'll think that probably it's not a good company, or it's not worthwhile investing, or probably something is wrong. But if we see the overall picture, how it's contributing to the society, how its brand is being built, how many customers are being catered to, then that will give us a comprehensive picture of that company. either from a public point of view, either from the investor point of view, either from the regulatory point of view, or as a general employee as well. So that's why integrated reporting has become very important. Previously, in a financial reporting was majorly based on our historical numbers, which probably are a very short-term thing, or they do not address the future of the company. Similarly, IR now allows capital markets for better understanding a company's strategy and performance story. How the company has performed, what are its strategy, how it is achieving all these good performances, all these things are being included in integrated reporting. Other than that, how it is giving back to the society, how it's creating value, or how it is adding value is the main thrust for this kind of reporting. Additional potential benefits include greater organizational clarity and streamlined reporting process at lower cost. However, practically speaking, wherever we personally have been involved in companies, integrated reporting does involve some costs. This is probably one of a challenge being faced in implemented integrated reporting, especially in India. Companies are not aware of it. They lack clarity on how to implement it. Plus, there is a lack of a proper framework for this, which I think needs to be taken up. Plus, the company also feels that a lot of cost has to be incurred for preparing such kind of reports. But once we are able to explain them the benefits of this kind of reporting, that gives a greater clarity and a picture of why they should adopt this kind of reporting. Again, by taking the first step towards the better business reporting, companies can bring in greater consistency and reliability to their corporate information. Now, these are the 6 capital disclosures which are required in such kind of reporting. First is the financial capital. Financial capital is the pool of funds that is available to an organization for use in the production of goods or the provision of services, and obtained through financing such as debt, equity, government grants, or any other kind of aid, or generated through operation or investments, which we also know it as reserves or surplus or profits. Financial capital, even in our earlier kind of reporting or financial reporting, was also a part of our disclosures. Second is the manufactured capital. Manufactured capital are the physical objects that are available to an organization for use in the production of goods or in the provision of services. These include all our property, plant and equipment and fixed assets, including our buildings, the equipments, the infrastructures, the plant and machinery, or any other such things, such as roads, ports, bridges, treatment plants, all things which help the company in manufacturing its goods or services are being termed here as manufactured capital. So manufactured capital also forms a part of the capital disclosures under the integrated reporting process. Third, and probably one of the most important capital which is included here, is the intellectual capital. Now, intellectual capital here is defined as probably the patents, the softwares, the trademarks, the brand, which have to be included in reporting under this capital disclosure. These also include expenditures on sustainability related to the research and development, monitoring of sustainability related targets. A very important part of intellectual capital today, in today's relevant for today's scenario, is the brand. Even if it is an internally generated asset, which are probably not accounted for financially in our books of accounts, integrated reporting wants us to disclose that as a source of capital as well under intellectual capital. A lot of companies or even startups or big companies, even if they are not making profits, they have big brand values. And to ensure that all the stakeholders and society have a clear picture on the value of that company, integrated reporting wants us to disclose a brand value under the intellectual capital head. So the entire brand value of any big organization, which probably is not accounted for as a financial number in its financial statements, also is captured in this integrated reporting. That's why in today's world, it is so relevant, because apart from that, if it is not disclosed, you would not have a correct picture of what this company is worth or what it stands for. Next is the human capital, which in today's going times is probably the most important, or which should be the highly rated or the highest rated capital here. Human capital includes reporting on people's competencies, their capabilities, their previous experiences, their motivation to innovate, including their alignment with and support for an organization's governance framework and risk management approach, their ethical values, such as recognition of human rights, ability to understand, develop, and implement an organization's strategy, loyalties, and motivations for improving processes. This will also help in improving their goods and services, and also includes their ability to lead, manage, and collaborate. So a lot of companies here which have adopted integrated reporting give a detailed disclosure on the human capital involved. All the key managerial persons, all the important people, all the professionals which they have, all the experts which they have hired, and what are their views on the company, and what are their plans for the company, and how do they see the company from their perspective, are now disclosed by such companies. This gives the investors, the employees, the confidence, the capital markets, and other stakeholders the confidence that how the company is being managed and run, or how that company is thinking, or where it is heading. So as you can see, this is a very futuristic approach which has been adopted in integrated reporting. And this is very important for anyone to understand where the company stands. So apart from financial numbers, these non-financial aspects also form a significant part here in this integrated reporting. Next is the social capital. Social capital includes the employees, the community, and customers. It includes reporting issues related to employee well-being, such as adoption and enforcement of human and labor rights and community engagement programs. In this past 2 years, which were affected by the pandemic, social capital has gained a lot of importance. It has gained a lot of relevance. Companies now share what they have contributed, how they have contributed to the well-being of the community and their employees and customers. This has gained more importance in these last 2 years, and it is probably has gained more importance than the financial profits. Well-being of the employees, contribution to the community as a whole, and serving the society as a whole have also become relevant for these companies to grow. Lastly, the capital disclosure is on natural capital. Natural capital includes things like air, land, water, forests, and biodiversity. It involves reporting on issues related to companies' understanding of the scarcity of these natural resources and what are the steps which they have taken in that direction. Similarly, the climate change strategy and how are they contributing in that? What are the carbon emissions of that company? What are the water consumption in that company? How it recycles the waste? What kind of waste it generates? So all these things, which are also quite relevant, have to be disclosed under this natural capital as part of the capital disclosures under integrated reporting. So as we all can see, these 6 parameters: financial capital, manufactured capital, intellectual capital, human capital, social capital, and natural capital. All these 6 become part of the capital disclosures under integrated reporting. All these are relevant, especially in today's context. That's why I say that integrated reporting is an evolving concept. And in these upcoming years, I feel all companies across the globe will opt for integrated reporting. Of course, there are challenges and it is not an easy task. But if they want to connect with the society, if they want to stay relevant, if they want to have maintain transparency, integrated reporting is probably the way forward. And even all the governments, all the boards have been focusing on how to build a proper framework for integrated reporting. It is probably not an easy task, as a lot of different companies working in different kind of industries have different concepts, have different types of capitals. To build a same framework or same guidelines for all is not an easy task. But yes, for them to identify the key parameters relating to all these kind of capitals and reporting probably can be done. Yes, companies will have a leverage. They'll have to use their own professional experience. They have to use their own disclosures to come up and give proper disclosures on all the relevant aspects which a company should disclose. So now we come to the conclusion that how integrated reporting is different. Integrated reporting is not the thinking is in an integrated way and it is not disconnected. In our earlier reporting, earlier form of reporting, only financial capital was what was being reported as capital. But here we have all forms of capital being reported. Similarly, from all those narrow financial disclosures, now we have a greater transparency as because of all these disclosures, which increases the trust factors as well. Previously, we were dealing with long and complex reports, but now integrated reporting focuses on materiality and conciseness. So now you have concise and material reports. The time frame which integrated reporting focuses on all the 3: short term, medium term, and long term. The companies have to report their objectives, the processes, their aims their goals for all short-term, medium-term, and long-term. Historical data which the company used to share earlier was probably we could see the company only in a short-term span. But now with all these things, we are able to forecast forecast probably correctly what are the way forward for that company. The key benefits of adopting integrated reporting are definitely that it improves transparency and governance. It improves communication with external stakeholders and promotes integrated thinking within an organization. It also helps the companies in getting easier access to capital due to better investor confidence. Once the investors have all this information, they are able to have a better confidence in that company, so which gives them a good access to the capital. According to the IIRC, which is the International Integrated Reporting Council, over 2,500 large organizations have already adopted integrated reporting. This has also been adopted in over 70 markets globally, which includes Africa, Europe, Asia, and South America. More than 40 stock exchanges have explicitly posted the International Integrated Reporting Framework in their reporting guidance. In 2017, our SEBI in India also called for the top 500 listed Indian companies to undertake integrated reporting. They recommended all these companies and other companies to undertake integrated reporting. Even though there was no I request everyone to please mute themselves. If you have any questions, please feel free to post them in the chat box. Yeah, so continuing, in 2017, SEBI called for the top 500 listed Indian companies to undertake integrated reporting. The Bombay Stock Exchange is also working on building the integrated reporting into their corporate governance scorecard. The Bombay Stock Exchange has also said that it will assess companies listed on this stock exchange based on the governance scorecard. Government endorsement of such measures will lead to a greater promotion of integrated reporting. There are a lot of roadblocks for integrated reporting as of now. Firstly, there is a need for creating awareness of integrated reporting and its advantages in India. Moreover, companies are required to report the information in varying ways and formats, which highlights the need for a clear framework. Until and unless we have a clear framework, companies would not be able to adopt integrated reporting in the manner desired. Additionally, there should be incentives also for adopting this kind of reporting. Another thing which the business leaders feel is that integrated reporting will require additional costs. It will require additional expertise to prepare this kind of reporting. It will require different skill set for this kind of reporting. But they have to be taught. Awareness has to be created. The advantages of integrated reporting have to be told. In addition, till the time investors push for such kind of reporting, it will be difficult for all companies to adopt it. Some of the suggested measures for government and regulators to ensure that integrated reporting is implemented smoothly are to provide a clear framework of the IR or the integrated reporting, to incentivize its adoption. Whichever company adopts integrated reporting should be incentivized in some way. Plus, the way it has made mandatory in a phased manner the Ind AS, it can also bring in some aspects of integrated reporting as mandatory for the listed companies. Thankfully, a lot of listed companies in India are voluntarily providing information related to integrated reporting. The corporate reporting in India is evolving with the changing regulatory environment, both nationally and globally. Companies in India produce multiple reports that serve different needs, and they have also inbuilt integrated reporting in that. As of now, they are issuing annual reports, the corporate social responsibility reports, the business responsibility reports, and the sustainability reports. A lot of information in these reports are being used to report in their integrated report as well. They are also showing reports showing their compliances with emission and effluent standards. Now, having so many reports confuses the readers of both financial and non-financial information of the business. Now, over the years, India has made significant progress in adopting such kind of reporting. In 2017, SEBI also formed the Kotak Committee to help improve corporate governance in listed companies, which helped them in this kind of reporting. Now in India, we see companies such as Tata Steel, Mahindra and Mahindra, Wipro, Reliance publishing integrated reports. I advise each and every one of you listening to go and see those reports. These reports give a clear understanding about the future of the company, how the direction it is heading, how does it will achieve that direction. In 2018, more than 30 companies in the Nifty 50 adopted the integrated reporting framework. By 2019, more than 45 companies in the Nifty 50 were expected to have adopted this framework. In the various categories, for example, financial services, companies like Axis Bank, ICICI Limited, HDFC Limited, SBI Life Insurance, Yes Bank, all these companies have adopted integrated reporting. In the automotive sector, we have companies like Apollo Tyres, Mahindra and Mahindra, Maruti Suzuki, and Tata Motors. In the consumer goods sector, we have companies like Dabur, ITC, Tata Global Beverages, who have adopted integrated reporting. Similarly, in the metal and mining business, we have JSW Steel, Tata Steels, Tata Metallics, and Vedanta. In the software services, we have Mindtree, Wipro, TCS, and Hexaware. In oil and gas, we have Indian Oil. In utilities, we have JSW Energy. We have Adani Transmission. Others include Bharti Airtel, Cipla, Havells India, Indian Hotels, Larsen & Toubro, Thomas Cook, Titan, and Voltas. All these big companies are now converging to integrated reporting. This has helped their investors and the stakeholders to get a very, very clear picture of what the company intends, how it does business, how does the management think, what are the plans and strategies, and what are the goals. This has improved transparency as well. People are now placing more reliance on such kind of reporting over the previous kind of reporting. Of course, this needs constant alignment and updation to cater to this dynamic needs of the society. But this is a very big step towards integrated reporting. The ongoing pandemic has also reinforced our belief that inclusive growth is more important to shape the future. I believe this decade we'll see a big progress on integrated reporting, as it is an opportunity to not only differentiate the companies, but also to contribute to shaping a more vibrant Indian economy. Thank you, everyone. If there are any questions, please feel free to share them or discuss.